Hey there traders, welcome back to another Commitment FX video. Thank you so much for checking in. I've got something different for you guys today. I'm going to be showing you an insight of the videos we post over on Commitment of Traders Club, whereby we promote our weekly outlooks, giving an insight into the trades which we have planned for this coming week. So you guys can learn something from this video, identify some trends on trades which could be good for you guys this week, and also see the type of videos which we release over on the Commitment of Traders Club. Without further ado, I'll get straight into the video as planned, and we'll see you guys in the comments below. So a pair which we don't look at too often, but a very nice one for this week is Euro New Zealand dollar. Let's have a look at what the chart is telling us before we break down what the institutions are looking at. So as we can see, we're looking on the daily. The market has had a very nice push to the downside all the way back from March 2020. So over 2-year downwards push. So it's very clear that we're in a downwards trend. What we can see that the market has been continuing to make lower lows and lower highs as we've pushed along. In more recent weeks, we've had the formation of a new low, and now the market is pushing back up. This is quite clearly a retracement. Now, what we could say is we're going to have a formation of a double top here. However, Friday's candle has closed very bullish. There's no indication that this area is going to hold. So we need to build our confluences in our favor to tell us why we want to execute a trade and in which direction. Now, number one, the trade direction is always going to be to the downside. We don't want to be counter trend trading unless you are very skilled at it, but we want to be following the trend to capitalize on big moves such as this move here, for example, or even longer if you are looking to hold a position perhaps over a good few months. So what we want to do is build our confidence. We know the market is trending to the downside. Now, what are the institutions doing? Let's head over to the COT Data and see what's going on there. Over on the COT Data, we're looking at Euro. We can see that in the previous week, the institutions have closed out long positions, 642, but opened up a very nice amount of short positions, 7,100 odd. And what we can see is that the overall net positions have been decreasing. Back in March, we had a very nice plus 64k net positions, almost 65. And ever since then, the institutions have closed out long orders, added some shorts, and overall we are now less than half the position, or more than half the position where we were back a few months ago. So it's very clear that the institutions are closing out their long positions. Therefore, the euro is getting weaker. Let's check over on the New Zealand dollar just to see what the institutions are doing over there. Over on the New Zealand dollar, we can see that it is very messy over here. The institutions often open and close similar size positions. But let's look at the net positions and see where we are. Equal time, 1st of March, we were minus 14k net positions to the short side. Since then, institutions have been adding longs and closing shorts, but overall adding more longs than adding shorts. So we're now plus 365 positions to the long side. So we're definitely in a stronger position in the New Zealand dollar than we were with the euro. The New Zealand dollar has been growing in strength, whereas the euro has been decreasing in strength. So we know where we are. Looking at this then over on the chart, we can confirm that the euro is likely going to continue to the downside, bearing in mind it has been losing its strength. Now, where is that going to happen? Build our confluence. We know the Fibonacci works from our previous analyses of different pairs and our own back testing. We take the Fibonacci from the high down to the low, and what we can see is our magic number, the 0.618 zone, has been pasted onto the chart. Now, this is all well and good, but it has to match up with previous levels. And what we can see that in fact here on the daily, it matches up very nicely. We've got a series of sideways movements here, and we'll draw it on with a square. Series of sideways movements, which means that there's been a pause in the market. The market has built up or slowed down, and more importantly, almost bang on the 618 zone, we've got this very important candle pattern here. This shows us that from this bearish move to the downside, the market paused very briefly. It pushed slightly to the upside and then immediately melted to the downside. These one-off candles where the market is in a very strong move, has a period of pause, shows us that there's some activity in and around this level. It matches up with our 618 zone, so it's a very strong likelihood that the market is going to continue to the upside, find a moment of pause at this level, and then in line with the overall direction and the COT data, is going to continue to the downside. So this is the area where we want to be looking at. So I suggest you all set an alert at this level to wait for the market to push back up. Remember, we want to be patient. We don't want to be aggressive and just put a short order now, because more than likely you're going to get stopped out. So our short order will probably look something like this. We'll have a stop loss above the structure, and our target is going to be at least to the bottom here, but we're looking at least to target below. We know that the market likes to create new lower lows, so we can have our take profit one at the base of the low. Now, some of you who've watched the previous videos and you know my trading strategy well, I like to put my entry where the masses put their stops. So we can move our entry up a little bit and we can reduce our stop loss significantly. That way we're not subject to market manipulation and liquidation grabs from the institutions, which are looking to target the majority of the stop losses. That way we get triggered in when the market does trigger most people out, and we get a higher risk to reward. In this occasion, you can see here, this would be a very nice 1 to 8 risk to reward. Be patient, wait for this bullish move to continue. We're still in this bullish market from the 1st of April. You do not want to enter a short position when the market is showing strong signs of bullishness. So a good area to put a alert on and wait patiently. The next pair we'll be looking at is USD Jpy, a favorite of mine, as you can see from previous analysis. So let's just get rid of our drawings. What we can see on USD Jpy is, and why I like it so much, is this pair follows trends over a very long period of time. You can see, and I'll give you the analysis again, from 2015, the market moved to the downside for about 5-6 years. The market has made a very nice period over 2 years, push to the upside. And you can see the depth and the range of these trends. There's no sign of any reversals. It moves very nicely. And in recent weeks, you can see the huge extension on the JPY. Now, why is the JPY showing a massive extension where other pairs are not? We need to understand what the JPY is. It's a safe haven currency. Much like gold, when the market gets a bit choppy or there are uncertainties in the world, the JPY will often prevail. And what we're seeing here, of course, is the USD is prevailing over the JPY. So it's got more strength than the JPY. Let's check in on the COT data and see how the institutions are also favouring the JPY. Heading over there now. So over on the JPY, you can see it's red, red, red. In the past weeks, we've had a massive decrease in institutional positions to the short side. So the short positions have been increasing. We can see that we've gone, and from my previous analysis, you'll notice that I was very pleased with the minus 62k net positions back in March, April time, whereas now we're almost at that double point where we're minus 107 net positions to the short side on JPY. Now, we're trading USD Jpy, so we need to reverse this data. This is telling us that the JPY is incredibly weak, so we reverse this and identify that the USD is incredibly strong. For those of you that are new, remember that the pairs on the COT data are traded spot against the USD always. So we're trading USD Jpy, we reverse the data and it tells us that the USD is probably plus 107k long. With this in mind and the overall change, we can see that there's no sign of this bullish movement stopping. So we don't need to worry about a reversal just yet. We do need to worry, of course, about technical analysis and common market moves. Well, let's have a look at what the market has been doing recently. It does have very brief moments of pausing and coming for a retracement, but those retracements are nowhere near as deep as our 618 level, which we would like to see, so we can adapt accordingly. What we're having now is we're having a second period of retracement following on from here. Can we identify the depth of the retracement? Well, no, we can't. We can't really identify it. We haven't got our Fibonacci tool to go off of. As you can see, if I were to draw it on from this impulse to the high, our 618 zone does line up very nicely with our previous high. However, looking at the chart from a whole, it's clear that this pair isn't following the 618 zone as we would have liked. Let's zoom in on the 4 hour and see if we can identify anything of interest here. Well, what we can see is we have a very nice trend line in place. Drawing from here upwards here, the market is respecting a very clear trend line. Trend lines aren't what I like to trade. I don't like to trade it when it touches the line because the line is always changing. You can see from here the trend line would have been perhaps like this, or even from here you'd have drawn the trend line in this direction. So trend lines are always changing, they're adaptive in nature, but we can see the steepness of the trend. Now on the 4 hour, what we can see is the market has already found its moment of pause and it's had its consolidation. The people who were buying USD Jpy have found the new high. They've probably closed their positions, so the market will naturally come to a retracement period. But there's not really many sellers in here. I can't see a reason why people would like to step in and sell USD Jpy, especially with our knowledge, of course, knowing that the institutions are not doing that either. So it's probably fair to say that you could take a long position, ideally at the base of this level. You could have your stop loss below the structure and have it relatively tight because we know that deep retracements aren't in the nature at the moment, and your target could be somewhere up here. We want to ride this as long as possible. Some traders will know that we entered some positions way back here and we closed out very nicely at the peaks. So it's been very profitable for us this far. So a good one to look in and trade if you do tend to trade on the 1 hour. Not for me personally, I like to use the 4 hour, but you can see we've had a very nice indecision candle here on the 1 hour. That's a particular reason for me to enter, so you could already be in this trade. Again, no trade is risk-free, so do have your stop loss at a comfortable level. Perhaps even you might want to extend it below the trend line if you do tend to trade it. You'll notice I have my EMAs on the side. You'll know that I am not a fan of trading with the EMAs. I believe that you can understand the chart by actually understanding it and not just what some lines are drawing. But if you do find it of use, you may have your stop loss below the EMA or below the 50 period moving average or the 200, which is most commonly used for these sort of trades. So a very nice one to get into this week. It could hold some very nice profits, although it will take you a while to get there, but one which has a good chance of reaching it, bearing in mind the overall direction thus far. Next pair we're looking at is Gbp Usd. So looking over on the chart, we can see my previous analysis. Let's get rid of this. We can see that the Gbp USD has also followed a very nice trend for a considerable period, and anyone with a pair of eyes can see that this has been moving to the downside. We'll look at this on simple technical analysis before we get into the COT data. Very clearly, we've had an immense bearish move last week. What was this one here? This was on the 21st or 22nd. The market completely melted to the downside. We would say, therefore, that we are overextended on this pair, and we can look at this on the daily very clearly. Clear technical analysis, price action, we have an area of interest where the market found 3 times a period of support. We've now broken through that, so standard technical analysis dictates that the market will more than likely come back up for a retracement, find resistance, and then continue to the downside. Let's draw our Fibonacci from the high, currently to the low. Can we see a zone of interest? Not yet. The market may continue to move down, in which case our Fibonacci may move to our area. However, general price action shows that this is commonly what happens. Do bear in mind that Gbp USD is a pair which is subject to manipulation from the institutions. Looking over on the COT data, let's see if our analysis is confirmed. Over on Gbp, what we can see is very clearly over the past 5 weeks or so, institutions have been adding short positions and closing out and adding some longs, but overall the net positions have decreased quite dramatically. You can see here from mid-March we were minus 29k, even minus 12. Now we're down to minus 58k to the short side. So there's no indication of this selling off or buying off, I should say, at any moment. We will expect a retracement. We can see that the institutions have added some longs, so this will account for price to move in its standard waveform. So a good area to put a alert and see if you can get in. Now we know that it's subject to manipulation because it's very popularly traded. You may want to have your short position at the level. However, I would suggest put your entry where the masses put their stops. and then have your stop loss at a comfortable level. Therefore, you're not going to be subject to any manipulation and get stopped out before the market moves in your favor. But as we know, market moves in waves. We've broken through the level. Common sense dictates that we're going to find a period of resistance at some point. The final pair we're going to be looking at today is the CHF Jpy. Very similar to our good friend USD Jpy. And let's remove these to make it nice and clear. Again, we are very overextended, and you can see that because we're trading the JPY, the market is very similar to USD. You may want to therefore mirror your trade, albeit the trade is not as steep as the USD. Let's check in on the Swiss franc just to see how the institutions are faring this particular currency. Over on the Swiss franc, we can see that actually net positions are increasing. The previous week, or this week's COT data, we can see have been increased and shorts have been decreased. We're therefore finding a small increase in net positions. They are short overall, that mustn't be overlooked, but remember how short the JPY is. The CHF is therefore showing more signs of strength than the JPY. We know the JPY is incredibly weak at the moment in comparison with other pairs. So what can we see here? Well, we want to be looking for a good entry reason. Let's drop down onto the 4 hour. Let's see if we can get any. Looking on the 4 hour, we want to be starting to draw our levels in. This is looking like a major level. Why is it? We've got a high which was resisted. Again, resistance, broke through, found support, and hopefully now we're finding some more support. And we've had a very nice candle wick rejection, a pin bar as we call it, or an indecision candle. Market moved down, buyers stepped in, pushed price up. Again, you can see another pin bar here. So there's good indication on price action that the market is going to hold this level. Therefore, if you are looking to buy this position, if you want to do it as a market order, do so. However, patience pays. Wait for the market to hopefully come back to this area again. You can have your stop loss below the structural level. That's okay in this pair. And at least you want to be targeting this high, which should get you a nice 1 to 2. But we always want a 1 to 3 over here. So you can easily achieve that, albeit it might take you a while to get there. But just out of comparison, you're 1 to 3 and you can enter, forget about it and get triggered out or triggered in, will net you a nice 300 pips. So you can let this one play out and hopefully it will become a winner. So traders, 4 very nice opportunities this week. Some are very safe, some you need to wait patiently to come back to. But as I say, we are swing trading here to make these big 300 pip moves, which you won't make on the 15-minute time frame, and you'll be sitting there with more screen time than you need. In any event, traders, thanks for checking in. We'll see you guys on the next video.